Federal Reserve officials have reaffirmed their commitment to fighting inflation, but said it would take substantially more evidence of progress to be confident that it was on a sustained downward path. For more on the Fed's battle against inflation, we welcome in Anastasia Amoroso, who is the chief investment strategist over at iCapital. Anastasia, always a pleasure to speak with you and get some of your insights. So what do you take away from where the Fed is kind of positioning what a trend may look like and where and when it may feel comfortable pivoting or pausing?
Sure. Well, good to see you, Brad. And I think that quote that you just brought up from the Fed minutes is really, really telling. That was the most important takeaway for me from the Fed minutes, is that they need to see substantially more evidence. And it's really interesting because yesterday we had the stocks that rallied out of the gate because we seem to have started to get data that suggests that inflation is peaking. And for example, if you looked at the manufacturing ISM print, you saw the prices paid component come down significantly. In fact, almost as low as we saw in 2020. And then if you look across the board, there's goods deflation that's happening. There's fuel deflation. There's food deflation. So all of that is starting to occur. But again, back to that quote, that is not good enough for the Fed. And to your question and your point is, when do they actually start to pivot? Well, I think when the labor market cracks. And that was the problematic part with the news flow yesterday, is that we don't really see cracks in the labor market. Despite all the job cuts that we're talking about, the job openings are still hovering near all-time record highs. So that's going to take time. It's going to take more kind of economic growth pressure, I think, for the unemployment rate to eventually inch up. So, that's why for investors, yesterday to me kind of highlighted what we might expect over the next few months is this tug of war, inflation that seems to be peaking, but it's just not good enough for the Fed yet.
Anastasia, let me tick through some of these things investors have watched this week. I'm just writing them down as I ask you. So Salesforce just announced a 10% workforce reduction. Amazon cutting 18,000 workers. Bed Bath & Beyond this morning, bad holiday season, said they may go bankrupt. And Stitch Fix, this now crossing the wire. Its CEO is stepping down. As you step back, are these just all signs the economy is headed into a dark place at some point this year?
No, I don't think the economy is necessarily heading into a dark place, but I think a lot of these companies that you mentioned are in margin preservation mode. And to quote one stat in particular, if you look at the profit margin for the S&P tech sector, it was 24%. Well, it's now down to 21% because very quickly what happened over the last few quarters is the growth landscape started to deteriorate, but they've hired a lot. They've invested a lot in CapEx. So I think what the companies are doing right now is they're adjusting to this new growth environment and they're starting to lay off workers. And this is really difficult to say because obviously nobody wants to be laid off. But at the same time, from a company perspective, from a market perspective, that's sort of what you want to see is companies right-sizing their cost structures, because what happens on the other side of that, as demand eventually rebounds, those margins will expand pretty drastically. It happened in 2020. It happened in 2018. It happened after 2015, 2016. So I think the steps that these companies are taking now is to right-size the margin pressure, which ultimately will be a positive.
That said, Anastasia, if the Fed is going to be waiting longer or wanting to see more evidence that inflation is going to come down and take longer to wind down interest rate increases, that would seem to be especially hard for tech, because it's already been especially hard for tech, right? So does that mean that there's more downside there?
I mean, there could be, Julie, some more downside. I think we still need to see the flush out in the first half of the year. But I do also think we've seen so much reset across the board, and specifically in tech. So, for example, if you look at some of the tech multiples for some of the software companies, they went from trading at 20 times enterprise value to revenues to 5.5 times. That's a massive reset, and they're sort of back to these normal levels. We saw the multiple correction in semiconductors and real estate, for example. So I think the bulk of the interest rate pressure has already been felt. And by the way, I do think the Fed funds rate continues to rise, probably north of 5%. But the long end of the curve, I think, has peaked, and we probably shouldn't retest the 4.5% rates there. So that's, again, a positive to me that suggests that the reset in valuations might actually be just about fully complete. Now, the other positive that I would say is that tech was perceived as this secular grower that's just going to escape, the cyclical pressures. And of course, we knew that's not going to be the case, but we're starting to feel it now. We're starting to see cloud revenues slow down and the whole digital transformation landscape slow down. So the fact that that's playing out now is, again, in that reset category that I think needed to happen and perhaps has already happened.
Anastasia Amoroso, Chief Investment Strategist over at iCapital. Good to see you. Happy New Year. Talk to you soon.
Good to see you.